Market Recap. I'm Daniel.
And I'm Mira.
So today was, it was just absolute whiplash for anyone watching the markets.
Yeah, wild is definitely an understatement.
Right. U.S. equities were pushing higher into the morning, and S&P 500 futures actually peaked above 7,400.
Which, felt pretty good at the time.
It did. But then the narrative just violently flipped. We plunged to close down 0.4% at 7,337.
Oh, dragged down by that vicious V-shaped spike in crude oil.
Exactly, following those breaking reports of direct U.S. military strikes in Iran.
And for this deep dive, we're really going to break down that massive disconnect. We'll start with the overnight global stagflation warnings that were flashing red before the bell.
Right.
Then we'll dissect that afternoon geopolitical explosion that completely tanked the equity rally.
Such a sudden drop.
Yeah. And then wrap up with the corporate AI arms race, plus a look ahead to tomorrow's massive jobs report.
Perfect. And before we jump into the mechanics of this sell-off, a quick reminder that this deep dive is for market context and discussion only. It is not personal investment advice or an investment recommendation.
Okay, so let's get into session one.
Right. So what set the stage before the U.S. session? Because before New York even opened, international markets were already flashing these major warning signs about energy-driven inflation.
Yeah, let's look at overnight Asia first. We got the Bank of Japan minutes from March.
And they were pretty hawkish, right?
Surprisingly hawkish.
Huh.
BOJ members explicitly warned that elevated oil prices could trigger 1970s-style stagflation.
Wow, 1970s style.
Yeah, which essentially sets the stage for rapid rate hikes.
But wait, I have to push back there a bit.
Okay.
If they're printing hawkish minutes and warning about rate hikes, the Nikkei 225 still rallied over 5.5% overnight.
I know. It closed near 62,833.
Right. So how does that make any sense?
Well, it's that whole dynamic of currency weakness as imported inflation. Japan is walking this precarious balancing act. The yen is so weak, which is terrible for inflation, but great for Japanese exporters.
So it artificially supercharges their overseas profits.
Exactly. And it wasn't just Japan sounding the alarm. Over in Europe, we heard from the European Central Bank at 1:45 a.m. Eastern Time.
Right, Isabel Schnabel.
Yeah, she issued this really stark warning. She basically said monetary policy must tighten if the energy shock spreads.
Because supply chain disruptions are already reemerging.
Right. And you can actually see the real-world economic toll of this.
Yeah, tying those central bank fears to actual fiscal damage.
At 9:15 a.m. Eastern Time, a German tax panel projected a massive 87.5 billion euro revenue shortfall through 2030.
Oh, wow. 87 billion. That is staggering.
Right. And Germany's finance minister explicitly blamed the U.S.-Iran war and the resulting energy price surge.
It just shows how the physical economy is constrained while the virtual economy is decoupled.
Yeah, Europe's industrial base is so tethered to physical input.
Exactly. And then you throw in the carryover trade tensions from Wednesday evening.
Oh, right. President Trump's auto tariff threat.
Yeah, a hard July 4th deadline on the EU for those tariffs, which just adds another layer of margin pressure for global industrials.
It's a brutal squeeze across the board.
It really is. So just to wrap up session one, global growth is choking on energy costs, yet early U.S. trading actually tried to ignore all this macro gloom and rally anyway.
Which is wild.
Totally. Let's take a quick break and then look at how domestic data and breaking news shattered that morning optimism.
Okay, we are back. So for session two, what moved markets during U.S. trading hours today, Thursday, May 7th?
Well, the morning setup really cemented the higher for longer reality for the Fed.
It definitely did.
Yeah, at 8:30 a.m. Eastern Time, initial jobless claims unexpectedly dropped to 200,000.
Proving the labor market remains stubbornly tight.
Exactly. And then by 11 a.m. Eastern Time, the New York Fed survey showed one-year consumer inflation expectations creeping up to 3.64%.
And that data caused a huge reaction from Fed officials throughout the day.
Right. We had a whole chorus of them.
Yeah, Goolsbee, Hammack, Kashkari, they spent the day unanimously signaling an extended rate pause.
Which makes sense. Central bank credibility anchors inflation expectations.
Precisely. If they cut rates now, they lose that credibility.
Yeah.
But the crazy thing is, the market initially digested all this pretty well.
Right. The S&P hit its intraday highs around 10 a.m. Eastern Time.
Yeah, people were willing to swallow high rates if the economy was strong.
But then I mean, the afternoon geopolitical shock was just massive.
Total shock to the system.
Around 1:25 p.m. Eastern Time, the reports broke that U.S. forces conducted direct strikes on Iranian port facilities at Qushm and Bandar Abbas.
And the fallout was immediate.
Iran claimed to fire missiles at fleeing U.S. destroyers.
Saudi Arabia and Kuwait opened their bases to the U.S. military.
And then Iran dropped that huge logistical bomb, right?
Yeah, the strict new rules demanding a safe passage application for the Strait of Hormuz.
Commercial traffic just dropped to near zero.
To a total administrative blockade, which sent oil into absolute panic mode. WTI crude printed this violent V-shaped recovery.
Yeah, it plunged to $90.69 earlier, then surged to close at $97.40.
Brent jumped 5.8%.
And obviously, equities sold off hard into the close.
You know, the market tends to trade these events like unpredictable natural disasters.
Right.
Like a hurricane hits, you price in a disruption, wait for the storm to pass, and expect things to bounce back.
I really have to challenge that reflex, though, Mira.
Oh, why is that?
Well, if you look at it through a game-theoretic lens, neither side is acting randomly here. They are using geopolitical brinkmanship as negotiation leverage.
Ah, so it's highly calculated.
Exactly. And the U.S. is striking to force an end to the blockade. But U.S. intel actually admits Iran could outlast the blockade for months.
So this isn't going away quickly.
Nope. So to wrap up session 2, the day started with resilient labor data and ended with missiles flying and oil surging.
What a day.
Seriously. We'll take a quick break and then dive into the corporate side of the market that's honestly trying to ignore all this geopolitical noise.
Sounds good.
All right, let's get into our final segment, session 3. What is the corporate events recap and what do we watch next?
Well, while the physical world was in chaos, tech was just plowing ahead.
The AI infrastructure juggernaut.
Exactly. AI CapEx, as a cycle-agnostic arms race, remains essentially the only fundamental floor for the market right now.
It's the only thing holding it up. What were the big updates there?
So Scale AI secured a $500 million Defense Department contract.
That's huge.
Right. And Uber is integrating OpenAI for new voice features.
Oh, wow.
Plus, SoftBank is in advanced talks with NVIDIA and Foxconn to build domestic AI servers in Japan.
Which is incredible, but I have to point out, Daniel, this arms race isn't without friction.
True, the funding side is getting tricky.
Yeah, OpenAI's custom AI chip agreement with Broadcom just hit a massive $18 billion funding hurdle.
$18 billion, wow.
I know, it's a stark reminder of the exorbitant capital required to sustain these valuations, especially when discount rates act as gravity on valuations.
Yeah, that higher for longer rate makes $18 billion bets a lot harder to justify.
Exactly. Well, folks, that's the closing bell, though today it probably sounded a lot more like an air raid siren.
Yeah, no kidding.
We walked in hoping for some market relief, and instead we got military strikes in the Strait of Hormuz and crude oil doing a violent V-shaped bounce.
It's been exhausting.
I guess the only thing higher for longer than the Fed's interest rate target is the blood pressure of anyone trying to trade energy futures this afternoon.
That is for sure.
Look on the bright side, at least your portfolio isn't a commercial vessel stuck in the Gulf waiting to fill out a mandatory safe passage application.
Small victories.
Grab a stiff drink and celebrate making it to the close, because simply surviving this stagflationary roller coaster is a victory in itself.
I completely agree. So running through what to watch next for the next 24 hours, going into Friday, May 8th.
What do we have?
At 8:30 a.m. Eastern Time, we get the critical April employment situation report.
So non-farm payrolls, unemployment rate, and average hourly earnings.
That's the big one. And then at 1 p.m. Eastern Time, the Baker Hughes U.S. rig count.
Which is hyper-relevant tomorrow given all this exploding energy volatility.
Exactly. We need to see how domestic producers react.
All right, well, I want to leave you with a final macro puzzle to chew on.
Lay it on us.
With global tax revenues cratering due to energy shocks and central banks globally frozen by sticky inflation, are massive corporate AI budgets the only functional liquidity engine left keeping the global economy afloat?
It's a great question.
And if so, what happens to the margin if that single engine even slightly sputters?
We would love to hear your thoughts on today's wild trading session in the comments below.